Imagine for a moment getting a letter from a CEO that doesn't feel like standard boilerplate corporate stuff.
Right.
It's less a dry financial report and more like a real candid conversation, where you, the shareholder, are treated like a genuine business partner, not just some distant number.
Yeah, that's a refreshing thought, isn't it? It totally changes the usual dynamic
It does.
from just, being talked at
Yeah.
to actually being part of a dialogue.
Yeah.
You're invited into the thinking, the philosophy, not just the accounts.
Exactly. And that's precisely the spirit of what we're diving into today. We're looking closely at the 2024 letter from Thomas S. Gaynor, the CEO of Markel Group.
Hmm.
And this isn't just about the bottom line. It's like their owner's manual for how they approach business, how they think about growth, and what it really takes to build something that lasts.
So our mission today really is to unpack Markel's core principles.
Yeah.
You want to understand their unique long-term approach, see how their, pretty diverse businesses actually did in 2024.
And pull out those nuggets of wisdom, right?
Exactly. Those key ideas that define their strategy for what they call enduring growth. Maybe see how you, listening, might apply some of that thinking.
Okay, so let's kick things off with this really striking analogy Gaynor uses. He says Markel Group is like a redwood tree.
Yeah.
It just creates such a vivid image, doesn't it? Strength, longevity. What's that really signify for them?
Well, what's interesting is it's not just about being big. The redwood symbolizes, this immense lifespan and enduring resilient growth.
Uh-huh.
Markel was founded way back in 1930, so they're getting close to 95 years old. And 38 years as a public company.
Wow.
But in redwood terms, they think they're just getting started. This isn't a company playing for the next quarter. They're trying to build for generations.
And I love the connection he makes to the rings of the tree.
Right.
Each of Markel's 94 rings, their 94 years, tells a story. Surviving, growing through all sorts of economic weather, just like a real redwood handles fires and droughts. It really speaks to their adaptability.
That connection to resilience is absolutely key. Each year, each ring adds something to the company's DNA, and it reinforces their core belief in what they call the win-win-win philosophy.
Win-win-win.
Yeah, they genuinely seem to see business as this infinite, self-reinforcing, and enjoyable game where everyone actually wants to keep playing, not a zero-sum thing where somebody has to lose for someone else to win.
What win-win-win sounds almost, well, utopian maybe, especially today. Is that really achievable, or is it more of an ideal they aim for?
Yep.
And who are the three wins for?
It's definitely an ideal they actively chase. They believe it's the only sustainable way. So the first win is for their customers.
Okay.
It's about building durable relationships, not just doing transactions. They focus on providing solutions for long-term needs. They get that transactions happen, in the now. But relationships, those are built over lifetimes.
Right, so deeper than just a quick sale, okay? Then the
Yeah.
second win, their associates, the 22,000 people. Markel calls them an orchestra.
Hmm. That analogy really emphasizes the collaborative, skilled nature of their team, doesn't it?
It does.
It highlights that you can't serve customers well without a skilled, dedicated, harmonious team. It implies precision, dedication, a shared goal. They really prioritize caring for their colleagues.
As integral players.
Yes, integral players in this long game,
Mhm.
essential for delivering on that customer promise.
Which brings us to the third win, the shareholders. If they're really focusing on customers and associates, how does that actually create value for us, the owners?
See, this connects it all. Value for shareholders isn't some separate goal they chase. It's the natural result of getting the first two wins right.
Okay.
And Gaynor gives a really powerful example. Markel's share price went from $8.33 to around $1,900 over 38 years.
Wow, okay.
That's a compound annual growth rate of about 15%. He calls it 8 doublings. Or get this, a 250 bagger.
A 250 bagger.
Incredible, right? And the nugget of wisdom here is that patient, long-term thinking, rooted in actually valuing people and customers, directly creates massive shareholder value over decades, way beyond what short-term plays could ever do.
Okay, let's unpack that a bit. A 250 bagger is definitely compelling, but how does a company actually do that? How do they cultivate those deep roots, those resilient rings year after year? What are the practical rules, the core principles from Markel's owner's manual that let this redwood tree stand so tall?
Well, one of the most insightful principles, I think, is their idea of dual time horizons, forever and right now.
Forever and right now.
Yes, this crucial balance. They keep a truly long-term perspective, thinking generations ahead, But, and this is key, that's never an excuse for being complacent or underperforming today.
Right.
They had this zealous pursuit of excellence to constantly improve now because, forever is built one right now at a time.
So not either, but this constant kind of ambitious balancing act. What else makes them resilient?
Their diversification and specialization strategy is huge. They started in insurance, sure, but now they're a really diverse and resilient family of businesses.
And diverse is putting it mildly, right? The list is amazing.
It really is. Instead of listing them all, just think. They're in everything from like essential industrial stuff like bakery equipment to IT consulting, environmental services, even ornamental plants and affordable housing.
Wow.
This strategy lets them be leaders in specific niche markets. So they have deep expertise, but also the breadth to handle tough times in one area because other parts are strong.
That makes a lot of sense. A really broad foundation.
Yeah.
And managing all that diversity must require great people, which leads to their focus on attracting and keeping great leaders.
Exactly. They give leaders local autonomy with accountability. It's not just delegation. It's creating an environment where, as they say, winners flourish. It creates this contagious energy.
So freedom within a framework.
Precisely. The insight is you attract and keep the best by trusting them with freedom and responsibility, not by micromanaging.
Which you can probably only do if you have that rock-solid foundation they talk about. A strong, low-debt balance sheet. Why is that so critical for their long-term view?
Well, it's fundamental, a necessary precondition for everything else they do. Having strong capital frees them from undue time pressure to service debt.
Ah, okay.
It means they can always put customer interests first and make sound long-term calls without being forced into maybe damaging short-term moves just to pay a bill. It's financial freedom that enables strategic patience.
Another principle they mention is frugality, it sounds. Well, maybe a bit old-fashioned. But Gaynor shares this anecdote about investor Shelby Davis.
Yeah, the Shelby Davis story is fascinating. He apparently said the only common trait he found among all the great investors he knew was frugality.
Just frugality.
Just frugality. But for Markel, it's not about being cheap. It's about managing capital at incredibly low costs, making sure returns actually build company value with minimal leakage. And the really important sort of unheralded insight here is their tax efficiency. By patiently picking and holding assets for a long time, they defer taxes, effectively creating this low-cost internal funding source.
Ah, delaying the tax bill.
Exactly. The takeaway for anyone is that true frugality is about maximizing the impact of every single dollar, especially in overlooked areas like tax management, not just pinching pennies.
And humility is another core value. How does being open-eyed about the limits of our knowledge actually shape their business decisions?
It's basically about guarding against arrogance, against hubris. It steers them away from risky moonshots and more towards incremental improvements that compound day after day.
Slow and steady.
Sort of. They use a crawl, walk, run approach for new markets or acquisitions. Gaynor calls it a continual paranoia, which sounds negative, but it guards against that smug sense of self-satisfaction, complacency that can creep in and really undermine resilience.
A healthy skepticism.
Right. The lesson is that a bit of self-skepticism is a powerful defense against business failure.
And finally, this keen focus on capital efficiency. With so many different businesses, what does that actually look like in practice?
It means they have this 360-degree capital allocation view. They're constantly, dynamically assessing opportunities. Should we invest more in our proven winners, acquire a new business, buy minority stakes, repurchase our own shares?
Always asking where the next dollar goes.
Exactly. Always ensuring capital goes to its best and highest use. It's a constant, disciplined evaluation across their whole ecosystem.
So what does this all mean for you, listening, wanting to understand how durable, long-term businesses really work in this constantly changing world? It means these aren't just nice ideas on a page. They are practical, guiding principles that shape every single decision and build that resilience.
Absolutely. It's a real blueprint for sustained growth, showing that culture and discipline are just as vital as any financial metric.
Okay, these principles sound solid, but the real test is always execution, isn't it? So how did this blueprint actually translate into performance, the wins and losses for Markel in a tough year like 2024? They borrow a phrase from Clint Eastwood, categorizing things into the good, the bad, and the ugly.
Yeah, and overall, 2024 was described as good, but not great, which is pretty candid.
It is.
They had strong returns in public equities, continued growth in their ventures arm, and some really notable performance in parts of insurance. But Gaynor is quick to remind everyone they prefer looking at more robust and accurate 5-year and even 21-year data over just 1 year's noise.
Back to the redwood rings again.
Exactly. Not just the leaves from one season.
So let's start with their foundation, insurance. What was the good there in 2024?
Well, the good news included a definite improvement in their overall insurance combined ratio. It came down to 95.2% from 98.4% the year before.
Okay, and for anyone unfamiliar, the combined ratio.
Right, it's a key measure for insurers. Anything under 100% means they're making a profit on the policies themselves before you even count investment income. So 95.2% is good.
And what stood out?
What really shone was their international operations, led by Simon Wilson. They delivered an amazing sub-80% combined ratio and solid high single-digit net earned premium growth.
Sub 80. Wow.
Yeah, it's stellar. And those international operations, they're now a third of their total insurance revenue, which is incredible considering it grew from a scratch-and-dent acquisition, Terra Nova, back in 2000.
That's quite a transformation.
It really is. Plus, they saw bright spots in some U.S. specialty lines, too, like personal property and marine.
But it wasn't all good news. Where were the bad and ugly spots in insurance, and what did they do about them?
They definitely hit some challenges in certain U.S. specialty areas, particularly lines exposed to changing legal trends and inflation pressures like construction defects, general liability, things with long tails. But Markel's response was pretty swift and decisive. They did a holding company reorganization, put a sole CEO in charge there, made leadership changes, and importantly, they actually exited several unprofitable product lines.
They cut their losses.
They did. Gaynor even quoted the boxer Roberto Duran's famous "No Mas, No More" when talking about ditching an intellectual property insurance product.
Ah, okay.
And there's also a board-led review still going on to address these areas further. The lesson seems to be, act fast and decisively when parts of the tree aren't healthy.
They also mentioned technology and expenses. Why isn't the expense ratio a simple measure for them if they want efficiency?
Yeah, that's a really important nuance. They know they need increasing efficiency through better processes and technology, but they argue the expense ratio isn't a simple apples-to-apples comparison.
Why not?
Because their products vary so much in complexity. Think simple personal lines versus, say, highly complex surety bonds for huge construction projects. The latter naturally costs more to underwrite and manage.
So a higher expense ratio isn't always bad.
Exactly. Markel International, for example, had a higher expense ratio than the U.S. specialty side, but it generated much better profitability and return on capital in 2024. Technology, they say, is like the company's brain and nervous system, essential for sensing the world and reacting appropriately.
And what about their commitment to reserve redundancy in insurance? That sounds like they might have slipped up before.
It is, and they're commendably open about it.
Yeah.
Their goal since way back in '86 has been, we want our reserves to be more likely redundant than deficient. Basically, set aside more than enough for future claims.
Okay.
They admit the reserve deficiencies in late 2022 and 2023 were jarring. It was largely due to that unexpected post-pandemic inflation hitting longer-tail casualty lines, claims that take years to settle.
Caught them by surprise.
Caught them, and frankly, the whole industry, a bit flat-footed. They call it a valuable lesson that will make them react faster in the future. But, importantly, 2024 showed big improvement, with 5.4 points of favorable development.
Meaning they'd over-reserved again.
Yes, meaning they'd set aside more than needed for claims that developed during the year, which is a sign of returning financial strength in that area.
Okay, let's shift gears to investments. How did that side of the house do in 2024?
Investments had a good, maybe even very good year.
Yeah.
Their equity returns hit 20.1%. Now, that did trail the S&P 500's 25%, but it's still a strong result.
And longer term.
Over the last 5 years, they clocked a 12.8% annual return. And they stress this is all while sticking to their core four-part investment principles, basically, buying quality businesses at fair prices.
And what about those unrealized gains and the deferred tax liability? Sounds complicated, but they frame it as a big plus. Can you break that down?
It sounds technical, but the idea is pretty straightforward. Markel has this huge pile, $7.9 billion of unrealized gains in their stock holdings. Profits they haven't cashed in yet,
Okay.
which means they haven't paid taxes on them either. That creates a $2 billion deferred tax liability on their books. But for a super patient, long-term owner like Markel, they see this almost like an interest-free loan from the government.
Ah, because they can keep using that money.
Exactly. They can reinvest that money for years, decades even, before the tax bill finally comes due. It's a massive financial tailwind that really rewards their buy and hold discipline. Something that takes, as they say, discipline, constant resistance to short-term pressures, and 3 decades plus to build up.
And their fixed income? Bonds.
Very conservative there. They take little credit or currency risk, like 98% is array rated or better. They match the duration to their insurance liabilities and generally hold bonds until they mature. This steady approach generated a positive spread of $1.2 billion in 2024. Meaning their investment income from bonds significantly beat the effective cost of holding their insurance liabilities. Pure profit, basically.
Got it. Okay, lastly, let's touch on ventures. How did that collection of diverse businesses do, and is there a story that really captures what ventures is about?
Ventures also had a pretty good year for operating income and returns. Revenues grew 3% to $5.1 billion, helped by an acquisition, Fowler Environmental. Operating income was roughly flat at $520 million.
Why flat?
Mainly because 2023 saw some white-hot conditions, particularly in their transportation businesses. That just cooled off a bit in 2024. Perfectly normal cyclicality.
And the story.
The really compelling origin story for Ventures goes back to 2005. Their first partnership was with a guy named Ken Newsom and his company, AMF Bakery Systems.
Bakery equipment.
Yeah. It was described as good business with a bad balance sheet. Markel stepped in with their long-term view, and over 2 decades, AMF grew revenues 6-fold and operating income 10-fold.
Wow, that's impressive.
It's a fantastic, tangible example of that win-win-win philosophy really working, showing how they can nurture a business when they provide patient capital and strategic support.
And the CEO calls himself the CEO of CEOs within Ventures. What's that role involved? How does it tie back to their principles?
Yeah, his role is about attracting and keeping talented leaders like Ken Newsom, making sure they all share the core Markel-style values, and then making those crucial final capital allocation decisions, deciding where the next investment dollar goes across that whole diverse ventures portfolio based on opportunity cost.
Being the steward, basically.
Exactly. Optimizing capital across the whole family of businesses, making sure they're all set up to thrive long term.
You know, this brings up a really important question. For a company that's built so much on, well, intangible things like culture and long-term values, how do you actually measure success, especially when a lot of it doesn't neatly fit onto a quarterly report card?
That's a great point, and they tackle it head on. They bring in Aesop's fable, the goose that laid the golden eggs.
The goose.
Yeah, the goose represents the 22,000 plus people at Markel Group. They're the ones producing the golden eggs every day through their work. And they argue that book value per share, which used to be a decent metric for pure insurance companies.
Right, something investors often look at.
It just doesn't work anymore for Markel now that they're this diverse financial holding company. So much of their value is tied up in those ventures businesses, which aren't captured well by traditional insurance accounting.
So if book value isn't the right measure, what do they suggest we, or you, the listener, should look at instead?
They propose focusing on intrinsic value growth over time.
Intrinsic value. Okay, what does that mean simply?
Think of it as trying to calculate the true economic worth of the whole company, not just the accounting numbers. They basically combine the reliable earning power of their main engines. Insurance, ventures, investments, give that a reasonable valuation multiple, and then add in their strong liquid assets like cash and stocks while subtracting debt.
So it's their best estimate of the underlying economic engine's value?
Exactly. It's their attempt to gauge the real underlying value creation.
But they include a big warning label with this calculation, right? A Surgeon General's warning.
They do. They're very clear it's a directional indicator rather than a precise valuation. And crucially, it only makes sense if you apply it consistently over long periods. They say a minimum of 5 years.
And what was their estimate for 2024?
Their 2024 estimate came out at $2,610 per share. And they point out this reflects an 18% 5-year compound annual growth rate, an intrinsic value, compared to only a 9% CAGR in their actual stock price over the same period.
Interesting gap.
Yeah, and they say they've started sharing this calculation to bridge what they felt was a potential communication gap with investors. The takeaway here is really that you need to learn to look beyond the easy standard numbers if you want to truly understand complex, long-term value creators like Markel.
So why should you, listening, care about intrinsic value? Well, it's about learning to read the map, isn't it? To see a company's true underlying value creation.
Yeah.
It helps you understand how that pulley of intrinsic value growth eventually influences the long-term share price. It gives you a much more robust lens than just watching the quarterly stock market blips.
It lets you see past the short-term noise, appreciate the deeper currents of value creation, and focus on what might truly drive enduring wealth, rather than just day-to-day market swings.
We've certainly journeyed deep into the Markel Group's world today. We've unpacked their Redwood Cree philosophy, that win-win-win approach, and the really practical principles driving their long-term resilience.
Yeah, from the big wins in international insurance to the tough lessons learned in U.S. specialty and that compelling growth in the ventures businesses.
We've seen how commitments to things like frugality, humility, and really thoughtful capital allocation shape their path.
And they really emphasize this idea of stewardship, don't they? That their role is managing something bigger than themselves, something that contains multitudes. It's not just about today's assets. It's nurturing this living, growing thing for the future.
So here's a final thought to leave you with. How does that idea of stewardship being a guardian for future generations, not just hitting quarterly targets, how does that shift your perspective on what makes a company, or maybe even a personal project, truly successful and enduring? What kind of long-term stewardship could you apply to your own investments or even your personal goals, focusing on sustainable growth and maybe leaving something stronger than you found it?
It definitely pushes you towards thinking about responsibility and legacy, doesn't it?
Yeah.
A real shift from just short-term gain.
We hope this deep dive has given you a richer understanding and maybe sparked some curiosity to explore these ideas more. Until next time, keep digging, keep learning.